This is Don Rissmiller at Strategas, Baird's investment strategy arm. We have a quick video today to discuss some of the recent economic data flow because we've had quite a mix of data points. However, we feel there is a way to cut through some of this noise. The data that deals with the February time period has been notably weak. However, numbers that are dealing with March and data to come, leading indicators, look like they're suggesting quite strong economic growth. So the old news, what we see in the February data, is weather-related disruptions as well as some supply chain bottlenecks. We can see weakness in existing home sales, we see weakness in durables orders, and we could see retail sales suggesting a fade after a very strong January. If we look at new home sales, this in particular shows a decline that is quite weak. However, this looks to be against a backdrop of a very robust housing market. If we look at home prices, they are suggesting that U.S. housing is doing quite well. Home price growth of about 11% on the Case-Shiller index is something where the market is calling on new supply. And so it's difficult to get too negative on housing, even with some of the volatility, when we see home price growth this robust. We also can look at surveys like consumer confidence. This rose in March in the Conference Board survey, as well as the University of Michigan survey, and we're seeing something that makes sense against a backdrop of quite robust fiscal stimulus. We have money going directly into consumer accounts, and that is showing up as an increase in confidence. This is against a backdrop of economic reopenings in some states, and so this makes sense. And provided that the medical solution to the medical problem that we've had over the past year continues on pace, we should be looking at stimulus plus reopenings providing a durable boost. Because of this, economic growth in 2021 overall should be very strong when we look at the US data. We should have several quarters of double-digit GDP growth, which is rare, and the year as a whole will probably approach 7% real inflation-adjusted GDP growth. So this is a very robust profile, which we don't see very often. And it makes sense, given the depth of the downturn we had last year, that as we see reopenings, we will see quite a substantial bounce. The concern that's developing is really about inflation. And we are likely, for several reasons, to see a move higher in inflation in the near term. First, we're going to lap last year, so there are base effects. In other words, March, April, and May of 2020 were negative when we look at the CPI month-to-month numbers, as well as the core ex-food and energy CPI. So just based on a year-on-year comparison due to base effects, we should see inflation move higher. We also, because of the bottlenecks mentioned earlier, are likely to see inflation move up. Supplier delivery times are becoming stretched, unfilled orders are increasing. However, Fed Chair Powell is aware of both of these on the inflation front. And what we really care about for markets is inflation, but also how the Fed deals with inflation. It's really when we have inflation and the Fed fighting inflation that we get in trouble with risk assets. And right now, the Fed has indicated that they want to try to treat this type of inflation move as transitory. And that makes some sense to us. We would look at the base effects as essentially a mathematical piece of the puzzle. That will happen, but that's known to be transitory because we can look at the data beyond May and see that those effects fade. The bottlenecks are a little tougher to deal with. That is a true economic phenomena, but the price level adjustment is different than a continued inflation problem. So if we bid up prices of things that are tied to reopenings, we don't necessarily continue to bid up prices at the same growth rate in future years. And that's really what the Fed will focus on. They believe inflation expectations are going to be set in a global environment and over time. And both of those would suggest that inflation will come back down after a spike in the near term. So very robust growth with some inflation, but if that inflation is treated as transitory at the Fed, markets should have some ability to try to look through some of these near-term numbers. So that's what we have today. Thank you for your time.